Perfect time to bring on board Nandan Chakravarti, Managing Director, Institutional Equity Research with Axis Capital. Nandan, good morning. Good to have you on ET Now. Nandan, in a quick time, benchmark indices have appreciated by about 4 to 5%. It's been a vertical and a straight line, gain for benchmark indices. What, to your mind, has done the trick for Indian markets? Global liquidity, news flow, or hope that Reserve Bank of India will cut rates and that will take care of everything?
Okay. I was amused by the last sentence that...
well, that's the belief, Nandan, isn't it? Reserve Bank of India will cut rates and things will improve. I mean, just about every expert I have interacted with, that's the case everyone is making.
Well, it's a mix of everything, I guess. RBI, if it were left only to RBI to be able to revive growth, they wouldn't be able to do it at all, because historical trends from the difference between trend growth rate and the interest rates, they indicate that you need at least a 2% cut in the interest rates to be able to revive growth back to trend lines. On the other hand, if you do that, then inflation shoots up. So everything is not up to the RBI. To answer your question, I think it's a combination of various things. One is India is the least dirty shirt, as they say. That's liquidity is one of the main factors. Number two, oil prices, there are signs that oil prices will fall. So I think that's the second driver for India. The third is, if you look at incrementally, whether it's India, whether it's the world, incrementally, I think growth is reviving. The PMIs in China have also been good of late, and unemployment numbers and housing starts in the US have also started improving. There's a little bit of a paradox in the sense that when the world does not do well, India does marginally better, because obviously interest rates become easier, as well as oil prices, the stuff that we import. But if the world does well, then India does very well. So it's a paradox, because if they do a little bad, we do relatively better. But if the world does well, obviously there's far more money and growth flowing around, which also comes down to India. So I think it's a combination of various reasons, and politics, of course, incrementally has been very good.
Nandan, so what Nikunj was actually wanting to ask is, do we see more upside in the market, going by your least of the dirty shirt analogy?
Okay, now I think a lot of FY14 is discounted. I think from here onwards, what happens in FY14 will depend on how the government, both the government as well as the world evolves. And I think the main driver for FY14 will be what happens in the year after that, because ultimately what you're seeing through the next year, through the next calendar year 13, are the prospects for the calendar year 14, which is post-elections. So what you will see now is people, having discounted what's going to happen in calendar 13, will see what sort of reforms the government comes up with, and how the uptick happens in US and China on the global front, which will then decide how calendar 15 evolves, which is going to drive your earnings for calendar, PE ratings for calendar 13.
Nandan, so to your mind, is the risk-reward ratio currently not favorable in going long?
No, it is favorable, but you have to pick the stocks. So, for example, in sectors, for example, financials, especially the private financials, are still good. Then, because that's ultimately the biggest beneficiary of growth in India. So we have financials on the one hand. Then you have the non-OMCs, because OMCs, there are different factors there, especially the pre-election year. But the non-OMCs, the exploration plays, all three exploration plays, both on the private side as well as the public side, I think those are fine. Then there's telecom and media, where there's, sector-specific stuff that has happened. Competition has reduced, digitalization has emerged. So I think these are plays which offer very good risk reward.